In this video, we shall look at financial liabilities as a component of IFRS 9 financial instrument. If you haven't watched the previous videos under financial assets, kindly do so to get more enlightenment as we go into financial liabilities. Right. What then is financial liability? According to the standard IFRS 9, financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity. So according to the standard, there must be a contractual obligation to deliver cash or another financial asset. The definitions goes down, but understanding the first point help you to understand the remaining. So that is why I considered only the first one as part of the definition. So a financial liability is any liability that is a contractual obligation. So what makes it a financial liability is the contractual obligation to deliver cash and the entity who holds it, the entity that holds it. So there was a question that was posted on LinkedIn that was asking finding answers to whether income tax should be classified as a financial instrument or not. And several answers that were considered as correct was that with income tax, it lacks the contractual obligation to pay tax to the government. There is no contractual obligation in that. So that is why that cannot be considered as a financial instrument. So an example of these financial liabilities include a debenture loans, trade payables, redeemable preference shares. So someone will ask, why do we have shares here as a financial liability? What is attached to it is what makes the difference. Redeemable preference shares. We all know shares are considered under IFRS 9 as equity, but in this case, shares is considered as a financial liability here because of the redeemable. So someone who holds a preference shares in a company, that shares that the company has to classify it as a financial liability because at any point in time, the holder of this share can demand cash. It is redeemable. Alright. There is a possible exchange, but with ordinary shares, for that there is nothing like that. It can't be redeemable once it is bought. It has already been bought, but there can be transfer in between parties. Alright, that's transfer of ownership of the shares. Alright, so let's quickly move on. Initial measurements of financial liability. As I've already stated in my previous videos, the general rule for all financial instruments. I've already stated that before, and here we have it again. So initial measurements. All financial liabilities are initially measured at its fair value, less transaction cost, if not fair value through profit or loss. So all financial liabilities are initially measured at its fair value. So fair value here is the price that will be received when an asset is sold or when it's paid when a liability is transferred between parties in an orderly transaction. Yes, so that is what the standard IFRS 13 defines fair value to be. So we measure all financial liabilities at that price. Then when we are done, we less transaction cost. So transaction cost is any cost that an entity incurs as a result of what? Selling these liabilities, issuing these items, issuing the debenture notes. So an entity has to issue them, has to sell them. Alright. So the cost that the entity incurs in dealing with all this transaction is the transaction cost. So the standard says that initial measurement less the transaction cost. Another condition follows, if not fair value through profit or loss, which means that this condition holds if only it is not fair value through profit or loss. Why are we saying so? It means that at inception, an entity can decide to fair value its financial liability through profit or loss. If that is the case, there is a procedure to deal with, which we will discover later. But at this point, let's all have it in mind that all financial liabilities are initially measured at fair value less transaction cost if the financial liability is not fair value through profit or loss. Subsequent measurement. Financial liabilities are subsequently measured through amortized costs, except they are designed at fair value through profit or loss. So we have two measurement options here. That's the amortized cost, which in this case we can consider it to be a default measurement for financial liability. That's the amortized cost. And if you haven't watched the previous video, you wouldn't know what amortized cost is. So I would like to talk about it a little. So amortization, to amortize means to gradually write off the value of an asset or a liability, financial asset or financial liability. So the standard is saying that we can subsequently amortize the financial liability. That is to add the effective interest rate to the opening balance and lessen the amount paid and having the closing balance, which we will do that very soon. Except they are designed as fair value through profit or loss. As I said previously, an entity can opt to fair value through profit or loss at inception, but defaultly, financial liabilities are subsequently amortized. But an entity can also decide that for us, considering certain factors, we want to fair value through profit or loss. The standard gives that permission. Financial liabilities at fair value through profit or loss. So since amortized cost has been discussed severally on this page, let's talk about financial liabilities fair value through profit or loss. So we mean that they are initially fair valued with transaction cost expense to profit or loss. So with financial liability that is fair value to profit or loss, it is initially fair value, which means that price that will be received or paid when an asset is sold or liability transferred, that price is what is going to be considered. While we expense the transaction cost to profit or loss, so we consider it as a period cost, as an expense for that period, and we expense it to profit or loss. And subsequently, fair valued with all gains and losses sent to profit or loss. So the subsequent measurement, we will be considering the opening balances and the closing balances, whether there has been an increase or a decrease in the fair value. Since it's a financial liability, an increase in the fair value is a loss. An increase in the fair value is a loss, and a decrease in the fair value will be a gain to the entity that holds the financial liability. Since it's a liability, an increase in the fair value is a loss, while a decrease in the fair value is a gain, because income can be also referred to as a decrease. Income will result in a decrease in liability. A decrease in liability will result in an income. When your liability is reduced, it will result in an increase in income. Thank you very much.